So in today's podcast, I want to go over QE. I want to go over how that affects the price of money. And I want to go over how you should invest accordingly to the situation with the Federal Reserve and the price of money. So we want to go over what QE is and how it affects the value of the dollar. Now, a lot of people think that QE alone causes inflation. A lot of people think that if we have QE, we're going to have the CPI increase. Now, that's not really true. And there's two aspects to it. First of all, QE alone is not really inflationary. I think it supports inflation, but its ability to support inflation is not very high. And the other aspect to it is QE happens when you get massive deflation. That's when, when you get massive deflation, when you get recessions, that's when central banks, pull out their monetary tools and do QE and do other types of asset purchase programs. And so it's more so counter-deflationary than inflationary. So instead of getting the deflation that we would have had gotten, we get kind of the inflation that kind of counterbalances the deflation. Now, you have to realize that QE alone is not really inflationary. It promotes inflation, but alone it doesn't cause a large amount of inflation. In fact, alone, without anything else happening, it doesn't cause inflation at all. At least not consumer price inflation. And so what QE, quantitative easing, is basically the Federal Reserve will buy treasuries from primary dealers. Now, usually these primary dealers are banks, but the Fed also buys treasuries, or sometimes it's other assets like mortgage-backed securities. They usually buy from either primary dealers or they buy it from the financial economy, which is just on the open market. And so basically the banks usually are the main sellers of these assets. And so they'll sell their assets to the Federal Reserve. Most of the time, they're selling treasuries. And the Fed comes in here and the Fed says, hey, you've given me all these assets. And so in return, I'll sell you, or basically I'll pay you actually. I'll pay you with bank reserves. Now, the bank reserves, you can't actually use it to spend and you can't use it to invest. But I'm pretty sure you can buy treasuries with these bank reserves. And so what happens is the treasury account gains money because someone bought their treasuries, and now the Fed's holding the treasury accounts, the U.S. Treasury's debt. So basically the U.S. Treasury gets more money, but the bank's money, the bank's cash that they've spent to buy those treasuries are getting kind of locked up, basically. You could think of it that way. And so they can't really spend money in the real economy. Now the problem is what happens is when, QE alone will give the government money, but that alone isn't really inflationary. What matters is if the Fed does QE and the government starts running large fiscal deficits. Right when that happens, the government spends money into the real economy, and then that could create a large inflationary cycle. Now, why that hasn't happened in 2020 is because we've gotten massive deflation, and again, the government just canceled out the massive deflation with large amounts of inflation. And so we didn't see we didn't see a very different change in the CPI, where normally we should see a deflationary consumer price index. But the government, of course, was sending everybody checks. And so and of course, you have to remember that supply chains and production decreased by quite a bit, and people started saving their money. They stopped spending as much, and so there was an inflationary and a deflationary balance. The problem, however, is once that deflationary, let's say, cycle ends. Now, it's not really a cycle because we haven't actually experienced it. We just kind of crossed it out. But once the COVID fears are gone, if people still are financially frugal and they don't want to go out there and spend a lot of money, then maybe we won't see much inflation. But if people are going into the financial economy, going back to their old spending habits, and the government keeps on running these large fiscal deficits, it's very likely that we will get inflation. But that brings me back to, QE alone is it's not intrinsically inflationary, and you see that in the 2008 recession, where the Fed was doing, well, back then they were considered large, but today, I mean, they're not nearly as significant anymore. But they, back in 2008 to 2012, they did they did 4 rounds of QE, and that didn't cause inflation. And one, because we had massive deflation. The government also ran fiscal deficits at that time. Well, they run fiscal deficits every year, but I mean, they were running larger than usual fiscal deficits. And so inflation and deflation kind of cancels out. But what's very important for inflation to happen is 2 circumstances. If the government doesn't go out of its way to spend money into the real economy. So the way that QE could cause inflation without the government is if the banks that receive the bank reserves lend against their bank reserves. So, we operate under a fractional reserve banking system. And now most banks, but the ones that are large, have to have at least 10% reserve requirement. So if I want to lend out $100, I need $10 in reserves. If I want to lend out $1,000, I need $100 in reserves. And so, banks actually don't lend out cash, or actual money. They basically create money out of thin air, you could think. They create bank deposits out of thin air. And I could go over, I'll go over the kind of the history of that to give everybody a clearer understanding, because I think if I just say it, it's going to be very confusing for people who don't really understand it. So basically, in the past, what banks would do is banks would have gold because before gold was money. But I'm talking about money backed by gold, not actual physical gold. But banks would have physical gold. Well, I guess that means they have both gold and bank notes. So let me basically reword that. Banks had physical gold, which was money back in the day. I'm talking, way before the gold standard. Back in the day, gold and silver were money, and the banks had precious metals in their reserves, and they issued notes, bank notes, to people so that they could, people could exchange with paper instead of exchanging with the physical metals, because paper is much easier. And so if they wanted their metals back, they could just come back to the bank and exchange their notes for the gold. So they would first go to the bank, and somebody would deposit their gold there and would receive banknotes backing up their gold, so they could go back and claim their gold whenever they wanted to. And people did exchange in banknotes too. So, if I was to perform a service for you, you could pay me in a bank's banknote. And if I wanted the physical gold, I could take the note and go to the bank and cash it out for real gold. And so that was how the banking system worked back in the day, when everything was simple. Now everything's complicated. And the bank, would issue notes, which was as good as money, because it had, 100% backing by gold. But then banks figured out they could lend more money if they just lended people these notes that weren't 100% backed by gold. And so I could just lend out as many notes as I want and claim that it's backed by gold, but I don't actually have to have the actual physical gold in my reserves. And so that's what banks did. And so they could technically issue as many banknotes as they want, and it wouldn't really matter as long as people didn't come back and actually ask for their gold back, which is what happened in the 1930s, in the Great Depression. And, a whole ton of banks went bankrupt because they didn't have enough bank reserves to support their, the people trying to draw the money out of the bank. And so basically, you could think of banks as being able to create credit, which is technically a promise to pay, or money, which is today credit and money are essentially the same thing. So you can basically think it as banks could just create money, but there are limited abilities to create these loans and to create money is kind of limited to their profitability. And so it wouldn't make sense for me to create 100 excess loans or whatever if I don't think that those loans are going to be profitable for me. And of course, they need a reserve requirement, which is now 10%. But let's get back to the QE part and how that affects the inflation. So when the Fed does QE and they basically print bank reserves for the banks. So think of yourself having a bank account at some random bank. The banks that you're banking with probably also has an account with the Fed, which is basically the same thing as you having an account with your bank. And what they'll do with the Fed is, let's say the Fed prints $10 worth of bank reserves for the banks. Well, now the banks have the ability to lend an extra $100 that they basically just create out of thin air. And they have 10% to back it up, which is the $10. And so that is one way that inflation can be created through QE. And that's the more common way. But the way that would be created is if, one, if consumers are willing to borrow, and two, if banks are willing to lend. And one thing that happens if you look at the bank reserves, the excess reserves of the bank, they have been increasing, and so that either means that consumers don't want to borrow, or that banks don't want to lend very much. And it would make sense because debt is at very, very high levels, and so most lenders would want to charge high interest rates on the lending, or else they wouldn't want to lend much money. And I think that's some type of situation you have with the banks, where they are seeing high risk but low return on lending. And the other way that the printing bank reserves could cause inflation, however, this would probably be anti-deflationary, is if people wanted to, everybody wanted to take their money out of the bank. Now that would be deflationary, because the bank wouldn't be able to serve all of the money, because the bank just printed credit, which is your deposits at the bank. And let's say everybody wanted to cash their deposits at the bank, which is just numbers on a computer, and exchange it for cash. Well, banks don't have one-to-one ratio of deposits, checkable deposits, which are your deposits, to cash. So maybe they'll have, $15 in cash, and the customers at the bank will have $100 in deposits. So not everybody could get their money back. But if everyone tried to take the money, well, then that would probably be deflationary, because if it was an inflationary environment, I don't think many people would want physical cash, and I think they'd just spend it. And of course, wanting cash isn't necessarily an inflationary move either. But if the central bank comes and prints enough money for everybody or more people to be able to withdraw cash out of the banks, that could also be technically inflationary, but that's very rare. And that is also counteracted by some very likely earlier deflationary proceeds. And so what does QE and fiscal spending, how does that influence the US dollar? How does that influence currencies? Well, the thing is, it's hard to say, because currencies, they usually are cyclical relative to both equities, commodities, and other currencies. And so it's hard to say that something that happens once will happen all the time. But usually, when QE happens, is following a recession, because usually people, the central banks won't do QE for no reason. Now the Fed did not QE, which is basically QE but shorter term, in September of 2019. Now that was not caused by a recession, but that was caused by some pretty large issues in the repo market, where interest rates pretty much skyrocketed well, they say it's an unknown reason. But that was not large scale. That was relatively small. It was big, but compared to now, it's just a rounding error. And so the size is completely insignificant if you compare 2019's QE to 2020's QE. But usually when you have large-scale QEs, it's caused by recessions or, well, we haven't really had a depression with a QE, but if we get a depression, we'll certainly get QE. And so usually when we get depressions, the US dollar will rise because people believe that the US dollar is a safe haven asset. That's not necessarily true, but as long as people believe something is safe, a lot of people pouring into it will make it safe. And if you have deflation, that is good for currencies because that means currencies gain value relative to assets or other goods. Now, if you look back in 2008 to 2014, that was a big bull market for commodities. And I think a big reason is because from 2008, where they started doing QE, up until 2014, where they stopped doing QE, everybody thought there was going to be inflation or hyperinflation. And because they don't really understand that QE alone doesn't really cause inflation. And the fiscal deficits back then wasn't really enough to cause inflation. It was more so to counteract the massive deflation that was happening. And so I think all of this monetary policy in the short run, I don't think it's necessarily beneficial for the US dollar, but I think sometimes the reasons why you'll have QE, which is a recession, will be good for the US dollar, and then QE is kind of, it's not good for the US dollar, but the recession is great for the US dollar. And so usually in an environment where you have QE, because you have a preceded recession, usually the US dollar will not go up too much and it will not drop too significantly. In 2020, the US dollar actually went up and then it kind of came down and then it kind of went up again. And I'm talking about the dollar index, which is not necessarily the best measure because you're comparing the dollar to a basket of other currencies, and how well the other currencies are doing, well, that depends on a lot of their policies over there and how their equities are doing also. But in the long run, it's not good for the dollar. And in the long run, it's good for those countries who will benefit from a falling dollar. It's good for those countries that are keeping their currencies artificially low and selling their stuff to the United States at a discount price. And that's one of the reasons why the U.S. runs trade deficits all the time, because it has the reserve currency status. And when you have the reserve currency status, everyone wants to give you a discount because everyone wants your currency. And so it's very hard to not run a trade deficit when you have the reserve currency. But so, QE in the long run, it's not good for your currency because eventually you're going to get some type of inflation because, if money falls out of your pocket, it's probably going to fall into someone else's pocket soon. And so I think that long run, now maybe that's 3 to 5 years, maybe that's 10 to 12 years. Maybe that could be as soon as 1 to 3 years. Or, I mean, I doubt it's going to be in a few months, but I'm sure that in the long run, the US dollar will suffer, and currencies, I think especially in countries in Southeast Asia, will do well. And I think their equities will do well as a result of a falling dollar. Because especially when you look at the long-term debt cycle, that is a big problem that no one has really figured out how to deal with, and more and more true is no one seems to care about it. The bigger it gets, the bigger the debt gets, the less amount of people seem to care about it, which is it's quite ironic. Now, I don't necessarily think that the dollar, even if it suffers through a downward cycle, I don't necessarily think, it's going to lose the reserve currency status. Now, it might, but for the dollar to lose its reserve currency status, you either need someone else to replace it, like, as you see, the United States has replaced Britain, or you need, you need countries just to abandon the let's say, idea of a reserve currency. So everybody has their own currency, and you don't really have a reserve currency. Now, that's possible too, but the chances of that happening is not incredibly high, especially since everybody is so interconnected. But it's certainly a possibility. And I don't think we're going to go back to a gold standard, mostly because of politics, unless if we see some just very big, massive type of inflation around the world, then it's possible that some countries may implement a gold standard. But for the United States to do it, it would have to cut pretty much all of its government spending. And that's not a very likely thing, especially when you have the Democrats in office. So, how should you invest when the dollar is likely to go through a bear cycle? Now, I think you should, if you're going to go for currencies, maybe you should go for currencies in countries that have better monetary policy, better fiscal policy, so less spending in fiscal areas, and of course, more control over the monetary system, not letting interest rates stay low for too long. And for the long term, I think that precious metals are something to be that could be considerably beneficial from inflation. And equities will also be great, at least relative to cash and bonds. TIPS, which is the inflation protected bonds, treasury bonds, I think they will, I think they'll do better than cash and normal treasuries, certainly. But first of all, you have to trust the inflation numbers. And second of all, which is the CPI. And second of all, the yield on them are incredibly low. So I wouldn't recommend them necessarily. But through a stagflationary environment, I think they're certainly a great option. Foreign equities would be even better than a lot of American equities. And I don't necessarily know about foreign bonds because it would really depend on the country. But I think short-term bonds are a good option for an a likely inflationary event, while equities are overvalued, which is something you see today. And precious metals are, again, good. Now, I'm not personally a physical precious metals person, but I think an ETF would do well. and maybe mining companies. Now, for mining companies, you really have to take a good look at the management team, and you have to do a lot of research. Whereas owning the physical metal is a lot easier to handle. But, if you think that the United States, or probably the whole world, might receive inflation, that is certainly an option that could benefit you a lot.